Tuesday the 5th of January, Europe and the whole world indeed is swept in a second wave of coronavirus. Many countries are in complete lockdown, Denmark, England, to name a few, but the stock market doesn't seem to mind at all. Let me take you through the trades that I did today. What you're seeing here is the big drop yesterday in the Dow Jones Index. This is on an hourly chart. We then saw a really decent bounce in the Dow, and it's not like I'm counting waves, that's not what it's about, but a little bit of simple technical analysis. I felt like this was an overshoot and I wanted to shorten this area based on what I saw here, but also based on this area here being support. And you know the old story, support once broken should turn into resistance. So I shorted at 30,355. That call was made about 15 minutes into the US trading session, and a stop loss of quite a decent size stop loss, but a small stake size. This is what it looks like on a shorter time frame. I shorted around here, and this is what happened in the ensuing hour and a half. At one point I was 215 points in profits, but as it often happens with me, I am not very good at taking profits. I argue that the reason why I am a profitable trader over time is because I am good at letting my profits run. Unfortunately, when you are on a bull market and you like to short, you often are going to see this happen. And so I got stopped out with nothing to show for it. Moments later, I shorted it again at 30,330. So a slightly worse price than the 30,355 that I had shorted at about an hour and a half earlier, 2 hours earlier, maybe even 3 hours earlier, now that I look at it. And it wasn't the only thing that I shorted. This is the FTSE Index from this morning, very big rally up, and then just a gradual decline all day. And up here I decided that it was right time to sell short the FTSE again. So I shorted at 65.90. I'm just easing my way into my trading again after the holidays. So I did it on a 50% stake size rather than a normal 100. And that too actually looked pretty good. At this point I was 17 points in profit, but it too stopped me out. And so I shorted the double top, only to be stopped out about an hour later for minus 18. It still felt like a decent trade to sell short once more, and I was in profit for a few bars, but then I got stopped out. As I said, I also reshorted the Dow here, again a double top, and in fact I think this arrow here is wrong. I think I shorted it here, and I don't think my position was ever really in profit. And then after 6 p.m. with 3 hours to go in the US session, we saw a big spike up, just like a one-hit wonder, no follow through, but I wasn't around to short here. I would have if I had had the opportunity. I would have shorted right there on sell on close, but that's another story. It's easy to say afterwards. Bottom line is, I got stopped out for minus 130 points. Why was I focusing on the short side today? Well, there's more than one reason to that. I saw the opportunities. I'm fundamentally just a classical bar chart reader, price action reader, but I also at times look at the longer term cycles, and I noticed that this correction here with the top that we saw here is 72 weeks. So you may say, well, that's probably just a random number, 72 weeks, which happens to be about 501 calendar days. I call it the 500-day calendar, the 500-day cycle. But let me show you how frequently the 72-week cycle actually occurs. It's interesting, whether you believe in it or not. Those people that I have showed this, the ones that are disbelievers, I absolutely respect that. They will point out that there's many other reoccurring numbers like 33, 57, etc., etc. But I'm not so religious to whether it's 72, 57, or 33. It's if there is some kind of commonality, some kind of pattern, then I'm happy to take a chance on it, just like I took a chance on shorting right here, because at this point here, this was 500 calendar days from this top here, and that turned out to be the trade of my life. So, not knowing if this is a potentially a double top, that's the worst trend line I've ever drawn, but you get the picture. I'm thinking, well, it's a very little risk compared to the reward that I once saw. But let me show you how often the 72-week cycle actually occurs, and the whole idea of Fibonacci. 72 is not a Fibonacci number, but it is half of 144, which is a Fibonacci number. But take a look at some of the previous calls I made using Fibonacci numbers from prior highs or lows. 55, 34, 21, 13. Not majorly turning points. This is, but this area certainly isn't. But when you count forward, they all, which was that English word, they all gather at the same point in the future, which turned out to be a major low. Here's a few more examples that you can study in your own time. Now I promised you more information about the 72-week cycle, so here it is. Here's the very an example of the early chart that I studied about 20 years ago when I discovered this. This is the Dow Jones from 1996 to 2012, so it's a pretty old chart. And here I'm just reconstructing what I saw back then. I began to make a note of the highs and lows, and doing retracements, 61%, 78%, and all of that Fibonacci related nonsense. Not nonsense in a disrespectful way, but I'm not a great believer in ratios as much as I once was. I am much more inclined to trade price action and push the trend when I am in a position. But nevertheless, what I discovered back then was that there's starting to be a certain harmonic pattern, and I discovered that there was 72 weeks or 500 days between these peaks. And if you'd seen this like I saw it back then, you'd probably think, well, I'm just going to add 72 weeks and then I'll keep an eye on that date. And that's what I did. And so I predicted that there would be a low, or a turning point more correctly, on the 10th of October 2002. And there was. It was actually the bear market low of 2002. And then we had a secondary low on the 12th of March 2003. Actually, the FTSE made a new low, but the Dow Jones made a double bottom, or a slightly higher low, and then it was off to the races. One day when I have time, or if you want to do it yourself, you'll never guess what this high up here was a high from. Well, you can guess, can't you? And then the high to low in the crisis of 2007 to 2009, 72 weeks. So anyway, I have a top here. I'm not saying that it is top, but it could be, but it's certainly 72 weeks from a prior turning point. And that's why I think that it might be a good idea to consider the short side. I know that the whole world is against me on this opinion, and I respect that, but everyone was against me in February 2020, and that turned out to be the absolute trade of my life. And it's hard to live those downs. Once you have caught an 8,000 point move in the Dow Jones, it's quite hard to settle for 200 points. I admit that, and it's something that I'm working on. But you never really know what's going to happen, and you never really know what you're seeing. It's when I used to do talks about trading, I would often show people the chart, the logo of Federal Express, and I said, "Where's the arrow?" And people were like, "Oh, there's no arrow." But eventually, people finally came around to, There's an arrow down there. There it is. There you go. So to me, trading often is a part combination of psychology, but also you only really see what you have trained your eyes to see. It's late. Not entirely impressed with my trading today. I was plus 210 points on one position, and I was plus 17 points on another position. It was some $30,000 in profit, and in the end I ended up losing about the same. No, not quite, about half, but nevertheless a bit of a shitty day compared to yesterday, which was much better. But that's the way I trade. I prefer to move my stop loss to break even and then simply see what the market gives me. And I believe that if I repeat this day after day after day, I will eventually, or over time, be a consistent winner. All right. Good night. God bless.